Imagine you've owned an investment property for years and one afternoon you realize the rules you built your whole plan around have quietly shifted. That's where a lot of Australian investors are right now. And if that's you, it's not because you weren't paying attention. After Budget Night 2026, an established rental property running a $15,000 annual loss will no longer let you cut your salary tax. That benefit ends from 1st July 2027. But here's the part most people miss. Some of your properties are completely safe, some claims still work perfectly, and there's one type of purchase that keeps the full benefit. Let me walk you through exactly what you can and can't claim, step by step. Let me show you why getting this wrong is so expensive for you. Under the old rules, a $15,000 rental loss cut your tax by about $5,850 a year at a 39% effective marginal rate, according to the 2026 budget fact sheet. That was cash back in your pocket at tax time. Under the new quarantining regime for established properties bought after Budget Night, that same $15,000 loss gives you zero immediate refund. Over 10 years, that's roughly $58,500 in refunds you'd never see if you're a 39% taxpayer. Buy the wrong property and you turn a guaranteed annual benefit into an uncertain future one. So the order of these steps really matter, and here's where it starts. Step 1. Confirm which of your properties are grandfathered. This is the single most valuable thing you'll do today, because grandfathered properties keep the old rules entirely. The cutoff is 7:30 p.m. Australian Eastern Standard Time on the 12th of May 2026, according to the budget papers and the ATO. Anything you held or had under contract before that exact moment is fully exempt. To check, log into MyGov, select the ATO link, and open your income tax returns from 2022 through 2026. View your rental property schedule and note the acquisition dates. Then cross-check against your settlement statement for the true contract date. If your contract date is before that cutoff, you can keep claiming losses against your wages, for as long as you own it. Here's what grandfathering is actually worth to you in real numbers, and I'll run it 3 ways so you can find yourself. If you're on the lower end with a $6,000 annual loss, that's about $2,300 back a year for a 39% taxpayer. In the middle, an established unit running a $12,000 loss saves you roughly $4,680 a year. 39% of $12,000 per the budget fact sheet, which is about $46,800 over 10 years. And if you've got a heavier loss of $20,000, you're looking at closer to $7,800 a year. A new investor buying the identical property after Budget Night gets zero immediate refund. Same property, completely different outcome, and it all comes down to your contract date. Step 2. Understand exactly what quarantining means for you, because the word gets thrown around a lot without much explanation. From the 1st of July 2027, if you buy an established residential property after Budget Night, your losses don't disappear, they get fenced off. They can only be deducted against other residential rental income or capital gains from residential property, according to the ATO and budget fact sheet. They can't touch your salary, your business income, or your other investments. Now here's the honest part. If you don't have enough residential income to absorb them, they simply carry forward to a future year. So the loss still exists on paper for you. It just stops being a current year cash refund and becomes a long-term deferral instead, which raises the obvious question: what's that actually costing you? Let me show you how to work it out. Step 3. Model your own future tax position. Don't guess this, because your number will be different from anyone else's. Use the ATO individual tax calculator in the ATO online tools. First, work out your expected annual rental loss. That's your rent minus interest, rates, insurance, and repairs. Then run 2 scenarios. Scenario A includes that loss against your wages, which is what happens for grandfathered properties and new builds. Scenario B excludes it from your wage income, which reflects a quarantine post-budget established property. The difference in tax payable between the two is the annual refund you'd lose by buying established under the new rules. For most investors, that gap is several $1,000s a year, and if it shows zero for an established purchase, you've modeled it correctly. And here's where it gets genuinely important, because the next step could save you the whole benefit. Here's why that last step matters so much for you. Say you're weighing up an $800,000 purchase running an $18,000 annual loss. If it's a new build, you can still deduct that full $18,000 against your salary, saving you about $7,020 a year. 39% of 18,000 per the budget fact sheet. Over 10 years, that's $70,200 in real-time refunds landing in your account. Buy the exact same property as an established dwelling after budget night, and that figure drops to zero. $70,000 of difference based purely on whether the home is new or established. That is the single biggest decision you'll make in this whole reform. Step 4. If you still want that annual cash flow benefit on a new purchase, look at new builds. According to the budget papers, new residential builds bought after budget nights stay eligible for full negative gearing against your other income. That means an $18,000 loss on a new build still drops your taxable income and delivers you that roughly $7,000 annual refund. It's the only post-budget path that keeps the immediate benefit alive for you. But I want to be upfront with you here. This isn't a free pass. You need to confirm the property genuinely qualifies as a new build under the rules before you rely on it, and get that confirmed in writing from your accountant, because the established versus new line is exactly where the whole benefit lives or dies. Remember, any specific property figures here are illustrative, not a recommendation. Step 5. Plan your eventual sale, because there's a second change that interacts with everything you've just learned. From the 1st of July 2027, the 50% CGT discount is being replaced for individuals, trusts, and partnerships with cost-based indexation and a 30% minimum tax rate on net capital gains, according to the budget papers. The good news for you is the reforms only apply to growth that builds up after that date, so your pre-2027 gains keep the old treatment. Your quarantined losses can still be used to reduce a future capital gain, but that gain is now taxed under the 30% minimum rather than being half-taxed. Use the ATO CGT calculators to model both the old and new rules for each property before you decide when to sell. And here's the number that shows you what that shift really costs. Let me put a number on the CGT side for you. Under the old system, a $300,000 gain got the 50% discount, so only $150,000 was assessable. And at a 39% rate, your tax was $58,500 per the budget papers. Under the new 30% minimum tax on the full gain, that same $300,000 gain now attracts $90,000 in tax, an extra $31,500 on the identical nominal gain. Your carried forward losses can soften this by reducing the gain first, but the effective rate on what's left is still higher than the old discount. Less benefit up front, more tax at the end. That's the combined squeeze you need to plan around. Step 6. Document everything and get proper advice before you act. Keep your contract dates, your settlement statements, and your title records, because that single cutoff moment decides which regime your property falls under. Track your carried forward losses carefully each year, since they're the asset you'll eventually use against a future gain. And before any purchase after the 12th of May 2026 cutoff, sit down with a registered tax agent and confirm whether your property is grandfathered, established, or a qualifying new build. The rules are actually clear once you know them, but the dollar difference between getting it right and getting it wrong runs into tens of thousands. Speaking of which, let me show you the full cost in one number. Here's the whole thing in one number for you. Picture yourself buying a second established property after budget night and holding it for 20 years. You'd lose roughly $140,400 in expected annual refunds over that time. Based on the budget analysis, you would claw back about $55,500 in lower CGT by applying your quarantined losses against the eventual gain. But when you net it out, you're still around $84,900 worse off over 20 years compared with a world where you could fully negatively gear and keep the 50% discount. The lost annual cash flow simply outweighs the CGT saving. And that's exactly why knowing your options ahead of time matters so much. Before we recap the two mistakes that cost people the most, and I want you to avoid both. First, assuming any negatively geared property still cuts your salary tax. After the 1st of July 2027, an established property bought post-budget gives you zero immediate refund. And if you budget for a $7,000 annual refund that never arrives, you can end up with serious cash flow problems. Second, confusing the settlement date with the contract date. Grandfathering is decided by your contract date, 7:30 p.m. on the 12th of May 2026. So if you signed before that but settled after, good news, you're still grandfathered. Get those two things right and you'll sidestep the most expensive errors in this entire reform. Let's run it back fast so you've got the whole plan in one place. Step 1. Confirm which of your properties are grandfathered using MyGov and your contract dates. Step 2. Understand that losses on new established purchases are quarantined to residential income and capital gains only. Step 3. Model 2 scenarios in the ATO tax calculator to see the refund you'd lose. Step 4. Consider a new build if you want to keep full negative gearing against your salary. Step 5. Map your exit against the new 30% minimum CGT rules. And Step 6. Document every contract date and confirm the plan with a registered tax agent before you buy anything. If you've made it this far, you now understand something most property investors don't. Exactly what you can still claim after these changes. So do one thing today. Go and find the contract date on every investment property you own, because that single date decides everything for you, and it takes about 5 minutes. If you want to go deeper, our next video breaks down whether a new build investment property is genuinely worth it once you factor in these new CGT rules, and that's exactly the question you'll want answered next. Remember, this is general information only, not tax advice. Always check with a registered tax agent for your situation. I'm Sophie. I'll see you there.